Hello, Oracles. Well, last night we had the first debate between Trump and Harris. And then this morning we got the CPI data for August. So we're going to discuss today how the market reacted to both of these events. I'm not going to get into the details about what happened during the event, but I'm going to kind of break down a little bit of, just how the event unfolded and how the market reacted to that and what I ended up doing with my portfolio based upon that information. We're also going to take a look at the CPI data with the inflation that came out and looking at the readings there, how the market kind of digested all of that information, and then how the Fed could potentially be playing this information going into the rate cuts coming next week. Now, if this content is stuff that you like to see, please hit that like button down below, subscribe to the channel. I'm going to continue to go forward talking about what's going on in the financial markets, both on a macro and a micro level when it comes to individual stocks, and how individual stocks will be affected by the entire overall market and economy and all the news and what's going on, so that you guys as long-term investors will be able to understand what's going on in the market. And I'll give you news out there as far as what's going on in the market right now. So anybody who is swing trading will at least get some information. None of it's financial advice, but it'll give you some information as to what could potentially be playing out in the market. So first off, we're going to take a look at the debate last night. Again, I'm not going to get into the details about it, but it was kind of a lot less about policies and a lot more about finger pointing. And if anybody's seen epic rap battles of history, it's like a rap battle. These two are just kind of working on dissing each other and comebacks, and it was really more about that than anything else. So it's kind of disappointing. And for me personally, this is why I've always looked back. And for me, I've always said, hey, ultimately, it's going to be up to me. The choices that I make in my life are going to be making more of an impact than whoever wins the election. And I know every individual is going to be different. There's some people who are going to be impacted by it. But at the end of the day, especially financially, speaking strictly financially, for the most part, your decisions are what are going to affect your future and what's going to happen with what happens in your portfolio and your net worth. And for me, that's kind of how I've always viewed it. I'm not going to be able to change the game. I really just have to adjust my strategy based upon whatever party is in power. And I just have to adjust myself and my strategy based upon the rules that I'm playing with at the time. So whatever party is in power has rules, and I follow those rules, and that's it. So you have to adjust, very much like just investing itself. You have to be an agile investor. Just be agile, figure out what's going on, make the best decisions for yourself, for your family, and that's it. And that's what I've been doing for myself. And this election is going to be no different. On this front, for me, whoever ends up winning, so be it. I'll make adjustments to my portfolio if need be and go from there. So if you guys did watch the debate last night, you go ahead, feel free to post your comments down below. Again, it's not really all that political on this channel, but I'm all about free speech. So if you guys want to have discussions down there, I just ask that you are respectful about that. Have at it. So then moving on to the inflation that we got this morning. So we got CPI data that came in, and year over year, we got 2.5%, which was in line with expectations, down from the 2.9% we ended up getting last month. This is a very good number, again, keeping us under 3%, moving in the right direction. And it wasn't moving down too fast to make the market panic that we're going into deflation. Month over month, we came in at a 0.2% with an expectation of 0.2%. Now, in the long term, that's where the Fed basically wants to keep inflation anyway, between a 0.2 and a 0.3% on a month over month basis. The only little bit of a concern, and maybe it's not even a concern, was the month over month core came in at 0.3% versus a 0.2%. Now, again, when we're looking at trends, we have been trending down with inflation. So a 0.1% on a month over month basis on a core data reading is not really giving us a trend to say, ooh, this is something we need to be concerned about. Like, is inflation coming back? It's not something to concern ourselves with yet. If we end up seeing this maybe continue for the next couple of months, maybe look at it. But realistically, inflation is basically gone. We've gotten it down in line. The Fed has done their job, brought inflation down to where it needs to be. Doesn't mean that we weren't all affected over the last 3 years, but we are still at the point where now it's where it needs to be. And if it can stay at this level or a little bit lower going forward, the economy can kind of recover. And those of us who are out there, as far as the working class go, might actually be able to get a chance to catch up. The only caveat behind that is the unemployment. So again, you're looking at that 0.3% month over month core. Is that going to give something to the Fed to say, hey, maybe we really should just go 25 basis points and not 50 basis points because of the inflation? If that's the case, that could be very detrimental to the market and the entire economy. Because when you're looking at unemployment and the trends that's been going on lately, that has been accelerating. Yes, we went from 4.3% to 4.2% this month, but we've still been accelerating. The SOM rule has still been going up. So we're still trending in that direction. We're seeing some reports out there that there's a lot of jobs that are posted that are just ghost jobs, that are just job postings to kind of get people out there to see resumes and get feelers out, but they're not actually real jobs. So is the jobs market that we're seeing inflated artificially? Don't know. Again, these are just trends that you have to pay attention to, little data points and signals that we see that are going on out there to say, are we going in that direction of unemployment and recession, or are we going to be kind of actually be able to make this soft landing? Now, when it comes to layoffs, layoffs have still been in line with expectations. We haven't seen those going awry. So layoffs are still been pretty good. So we're still trending in that direction for a soft landing. But I am still preparing for a hard landing and a recession. And the reason being is because if any of you have played Super Nintendo or Nintendo recently, or even within the last 10 years, you're playing the game. And I remember a while back, I was playing Street Fighter 2 on Super Nintendo. And after playing other fighting games with like instant recognition when it comes to pressing the buttons, there's a delay. There's a delay when you hit that button, and it's very hard to play a fighting game or any game for that matter when there's a delay when you hit the button. It's not instant when you hit that button in an instant reaction. So when you're looking at what the Fed is doing with a soft landing, that's basically what they're trying to do is they're trying to land the economy. We've got a plane that is coming down, and just like you're flying in a regular plane, it's coming down to the ground. And if you're coming down too fast, you've got to make some adjustments. And if you're coming down fast, like we're seeing with unemployment moving up quickly, that's like the plane coming down a little too fast. But if the controlling of this plane landing has a reaction that has delayed, which is very much like a lot of their lagging data that they take in, or even just the cuts that they make having that lagging effect, or the fact that we still have hikes that have a lagging effect that we're still feeling going forward, that lag is going to cause problems. If we get some sort of unknown that hits the market, all of that is going to be thrown off. So if you're playing that game and you're trying to land this plane with a button that is going to be delayed, if everything is going smoothly, not a problem. You can make those adjustments. But if something comes in, a bird flies across and all of a sudden hits the windshield, that delay, you won't be able to dodge that bird. Maybe it goes into your engine. You won't be able to dodge it. Things like that could happen. And we have a 6 to 12 month window, I think, that the Fed is going to have to play this perfectly. And if anything comes in the next 6 to 12 months that is going to cause the Fed to have to react quickly, we might have some problems. And that's just my only real concern is obviously something could potentially happen over the next 6 to 12 months. We have the election going on right now as it is. That in itself is going to cause some problems. Oil is down at $65 a barrel. That is the lowest it's been in a very long time. Any sort of shock to that oil market going up is going to cause a bunch of companies out there to have higher expenses. And again, that's where they're going to start cutting on the payroll end. They start cutting on the payroll end, then all of a sudden you start to see unemployment ticking up faster. When you see unemployment go up by 1%, it will historically go up by another 1%. So just kind of monitoring that right now when it comes to the unemployment. And again, that could be enough. We're looking for one domino to fall because that is just how precarious we're in. Now, again, the Fed right now, maybe this is what it looks like. Maybe this is what a soft landing looks like. And it looks like a lot of things are kind of getting really close and we're going to crash. And then we don't. And we get that soft landing. Maybe the Fed pulls it off. But we are in a position right now. We're seeing a lot of data where, all right, the Fed obviously needs to focus hard on getting us to this point, and getting a 0.3 reading on that CPI core month over month could be enough to say the Fed's only going to do a 25 basis point versus a 50 basis point. That in itself might allow those tighter restrictions to kind of push us over the edge and get us to the point where some companies who are like, I really need to take on a loan just to keep this company going forward, but the rates are still too high and I cannot afford that. So because of that, they might get to that point where they're like, oh man, I can't take on a loan. I now have to go bankrupt. That company goes bankrupt. There's more people that are going to be unemployed. We've already seen the most bankruptcies this year than we've seen in 13 years. So since 2011, we have seen more bankruptcies. That continuing forward could be very bad news. Now we have a lot of companies that are out there. It looks like we have a lot of money on the sidelines saying, hey, well, if the market's coming down, we got a lot of people to buy the dip. A lot of that money is to buy the dip in a different way. A lot of that money is sitting in companies like Berkshire Hathaway, Apple, Microsoft. These companies have massive stockpiles of cash because what they do is they sit on that cash, anticipate times where companies are going to be struggling. High interest rates for the last 2 years has caused a lot of small cap companies to take on very expensive loans. If the rates continue to stay higher, if they have variable rates, they won't be able to afford those loans any longer. They then will go bankrupt. That leaves them prime pickings for these bigger corporations that are out there with all these stockpiles of cash to go and scoop up those companies. So the dip that these companies are looking for to spend that cash on is literally buying other companies entirely. Whereas retail investors like you and I are looking to buy the dip on companies' stock prices that are going down and hopefully not going bankrupt. So that's where the dip is different. And that money that's coming in is not money that's going into the stock market. It'll be money that's going to be by other companies. And if you're looking on the sidelines and thinking, hey, if we get a dip, we've got a lot of money that's going to come in and buy that dip up. That is not the case. And don't forget, we have an economy right now where credit card debt is at all-time highs. So it's not like retail investors are sitting out there with a lot of extra cash on the sidelines themselves. They're barely able to make ends meet because their credit card bills are skyrocketing. And again, if rates continue to stay higher and the Fed only cuts 25 basis points, those credit card interest rates are also going to stay higher. So be very cautious with that, especially if you're out there with higher credit card debt. Be careful because I know some credit cards are pushing up 30% on interest rates. That is a ridiculous interest rate to pay on your credit card for things that maybe you don't need. So be very careful with that. That's why the number one thing I did over the last 10 years was pay down all of my debt. Investing is awesome, but if you have to pay 30% interest on credit card debt, you're going to get nowhere in life. Your investing is going to mean absolutely nothing to you because the amount of money that you're going to get back from investing is not going to make up for the amount of money you're losing to that interest rate. So just be very cautious with that. And there's also some signs coming out right now where we know that when it comes to wealthy people, a lot of times people like Elon Musk and other billionaires, they have a high net worth, but they don't actually have a cash flow coming in. So what they do is they leverage all their net worth and whatever they have for assets and borrow money off of that and take loans on all of that. Well, one thing that a lot of wealthy people do is do that with art. A lot of the artwork that they have, they leverage off of that art and they borrow money off of that. Well, it seems like more recently we have been seeing trends from different banks that you're seeing those numbers going up, and more wealthy people are borrowing money off of their artwork because they can't sell their artwork. So again, the market out there to purchase things that, are more wants than needs, even for the wealthy, is starting to diminish. That means that even the wealthy are taking on loans and leveraging assets that they have to bring on that money. That in itself might even be a bubble. That might be something that could end up triggering us to go into a recession as well. If the wealthy are now having to borrow money to make ends meet or to pay off bills or whatever, because maybe they spent outside their means, if they are doing this and all of a sudden, hey, they can't sell their artwork and then other bills go up, they have to start selling things. They can't sell anything else that they have for assets. Now they're stuck with these giant loans that they can't pay off because they can't leverage anything else. Banks don't want to give them any more money because, hey, you've already leveraged all of the different assets that you have. That could lead us downward as well. Again, just another little signal that I'm putting out there. And I just keep on putting these little check marks in the pros and cons list, pros towards us getting to a soft landing and cons getting us towards a recession. That goes into the cons list. So I just check off both marks on both sides. And we are leaning more towards the cons side right now when it comes to a recession coming versus a pros and a soft landing. So I'm just making mental notes of all of these little things coming up to kind of give us the indication of what we might end up seeing in the future. So tomorrow we get PPI data coming out at 8:30 a.m. Eastern time. That's the producer price index, very much like the consumer price index, but it's the prices that companies pay versus what consumers pay. So it's kind of like the middleman. So it's what the middleman is paying for these products. And that typically has been a leading indicator of what we've seen going forward. So again, this could give us an indication, are we going into deflation? Maybe that 0.3% month over month core inflation number isn't something that we can say is going to be a trend. Maybe the PPI is going to give us an indication that it's definitely not a trend. It was like maybe a one-off blip on the radar. So we'll get those numbers tomorrow at 8:30 a.m. Eastern time, and we'll go from there. And I don't know if this is going to be one that's going to move the needle. Maybe it is, but I think the more important thing over the next couple of months is really going to be the election. And again, when you look at things from a fundamental standpoint, from a stock price standpoint, I think we're going to see a big disconnect over the next 2 months. I think we're going to see more movement when it comes to the election sentiment than we're going to end up seeing from what's actually going on in the economy. I think what's going on in the economy, if we get numbers that are awry, or maybe the Fed does something that shocks us, if we get something like that, it could move it more. But I think we're going to get more sentiment swings over the next 2 months than we're going to get actual fundamental movement on the stock market. So just pay attention to that. So any swings that we get are probably going to move more one way or the other. Plus, on top of that, corporations cannot do any buybacks between I think it's like the 21st of September, I believe, through the end of October. So if you're looking at any big money coming in to make some buys as far as a buyback goes, that's not going to happen. So the volume will be significantly lower for that time frame. And so be cautious of that too. So lower volume also adds to the volatility and the bigger swings in the stock market, which is a lot of times why buying sometime in October can historically be one of the better buying times, because lower volatility means if we have the uncertainty from the election could pull down a little bit further, especially if we get uncertain economic data pulling us down even further, could be a very good buy the dip opportunity. Again, still paying attention to what could happen with a possible recession. You want to make sure that you're, not just dumping all of your money in at that time, because yeah, we could dip and maybe come back up after the election, but might dip down further again after that also if we get into that recession. But it's one of those times where maybe it's a buy. For me today, the way the market reacted was we sold off into a nice strong dip early in the morning and then climbed right out of that as the day went on. Worked out great for me. Again, following my spreadsheet. My spreadsheet at the beginning of the day said I had no money to spend. I looked at my spreadsheet partway through the day and I had $60 to spend. So I spent $60 on a lot of different things that, were showing up on my radar to say, hey, these are below your target. Go ahead and buy these. So I bought all those up. And what ended up happening is I spent that $60 and it bought me $3 a month in income. So that's the way I look at my whole strategy right now is I am buying income. And when I see opportunities to buy more below my targets, that means I'm buying more income at a discount. So my spreadsheet told me to buy some. I bought some. I bought $3 a month worth of income. I'm very happy with that. And then the stock market went up again. And now I don't have any more money to spend. So now my spreadsheet's telling me stockpile some more cash and get ready for that next dip. And that's what I'm going to do. So that's all I've got for you guys on this one. Let me know your thoughts in the comments below as to what you think is going on with inflation, how you felt about the debate. Thank you so much for watching. I appreciate all of your support. Have a great one.